up. We we have a few of our agents. One is in Canada right now, and the other one is actually in the hospital. She's just getting a routine thing, but so I'm like, oh goodness, we got to get you guys here.
Gotcha.
So
Um,
And Mike, I just wanted to let everyone know I've got a hard stop here in about 15 minutes. Mike's really the driver of the meeting, but I thought it would be nice to just see some faces so that if we're working together, that we'll get to see each other every now and then. So
yeah, which is just
perfect.
a pretty one.
Cool.
if you see me drop off, that's why.
Yeah.
Okay.
So, Mike, can I ask you a quick question?
Yeah.
So, a while back, you mentioned that something about getting certified. So, what does that mean as far as agents like me, working with Nadia? What did you mean by that certification?
So we used to do a lot more of like a certificate. We called it a certification, right? Where we'd go through some different classes, etc. This is like way back. This is like literally 2 years ago or so. Um,
Okay.
and I think like we talked with you and Nadia that we've kind of pivoted away from like just every agent out there being able to use us, and we're kind of like focusing on specific brokerages and teams, etc. that partner with us. But it will do a lot more, I would say, training. Like I have Zooms that I have set up for every Tuesday and Thursday from it's 10 o'clock our time, so it'd be like noon to 1 your guys' time, where you go on there and you guys can ask all the questions you want. Once we have like your guys' purchase contract down, because there's not really any good state purchase contracts that are really good at assumptions. We'll go through that and try and figure out the best practices and basically help train all you guys from A to Z on assumptions. And that would be more of like the, hey, I've gone through all this different training. And especially the reality is, I mean, you could learn all the academia, but you have to experience at least a couple before, you really kind of you get it. You understand how it works, right? Because the main thing for you guys as agents is going to be how do you set your buyers and sellers expectations? Because if you set them well at the beginning and continue to be consistent throughout the transaction, it's going to be I'm going to call it a relatively smooth transaction. Very bumpy in comparison to traditional financing, but smooth in general in the assumption world. But if you don't set expectations correctly and you kind of maybe a little oversell, under deliver, it's going to be like the worst transaction of your life because the emotions of these buyers and sellers is going to be brutal because they don't have any concept of what an assumption's like, and they're going to compare it to like the most recent new financing deal that they had, and it's going to seem like it's the worst thing that they've ever done. So it'll definitely be about setting expectations for
Okay,
sure.
that's
Perfect.
that's really helpful. I was concerned because you had said, I wanted to start marketing and such, and so I didn't, I didn't quite understand if you were, and I wanted to get a website, with my direct link, so I didn't know really what you'd meant by that. So by being
Yeah, that's
certified,
part of
I
what you
appreciate
guys are able to do within your guys' home website. Is that something that you're like whoever is going to be like, I guess, the contact for administrating your website, that's where they'd have to go through more with Travis and our tech people as far as
it.
like,
Okay,
okay, how does this all work on the website side? But
okay,
um,
okay.
Okay.
I'm thinking a little bit more of like, tell me if this is your guys' expectations too, is this initial kind of like sit down and Zoom is more to go through assumptions in general to give you guys kind of like the assumptions 101, let's call it. Um, so you more understand like from an academia perspective what they are, how they work, etc. And so that was kind of my plan. But of course, like as you guys have questions, just interrupt, and that can kind of like I can steer to whichever questions you guys are looking for the entire like me kind of training you guys.
Yeah, no, I think that's great. If you could go over, because a lot of the agents that are on here and that will be coming on, they're very new at assumptions. And also how to talk to the other agents so that we can get them to persuade them to sell it with an assumption. And then I can get with Travis to do the back end with Art. We can go ahead and get that set up.
Okay. Yeah, that's something totally separate that
Okay.
we don't want to spend time on here, but let me here I'll share my screen
Okay.
and the I just kind of have a let's see. I'm going to leave it in this form. If I just usually I have it really
Yep.
a bit nicer presentation, but this will kind of guide me as to like what we can go through. And let's start. So let me ask you guys. So Art, I kind of know, and then who else do we have on here? A few others, I think. McKenna, and we have Zoom user on here. Wow, Zoom user, got it.
Yeah, that's Randy Moss. And then we have Marina as well on here.
All right.
We have a few others that will hop on. They're just trying to get off work.
Okay, so say Randy and whomever else is on, is there anything in particular, like very specific questions, no matter how high level or low level that you have that you want me to make sure that I kind of address? And I'll definitely make sure to get through that. But anything like initial questions where you're like, I just really want to know this.
Marina just says thank you. Yep.
Well, particularly, I'm particularly eager to get a few tips on how to market and how to engage other agents. So I know you guys are pros at that, and I don't want to have to recreate it. So I'd rather learn from you than, spin my wheels. So I've been doing a little bit of agent outreach. So I'm excited to get to that part. So
Okay,
what?
so market and agent outreach. Okay, and then Randy.
Yeah, the concept of the assumable. So I'm just as a baseline, I'm here in Ohio.
Okay.
Nadia invited me to this out of the graciousness of her heart, and I'm super excited to learn and understand. Because I am so wildly curious if this is something that could apply here in our local market, but also as we look to acquire properties down in the greater Florida area, Tampa in particular, if there are learn about what those opportunities exist, if there are state, local, municipal financial regulations that are governing each municipality, if it's a little different, a little here, a little there, and how we go about identifying those opportunities.
Gotcha. Okay. Anything else in particular, and I can kind of just jump into it. Anybody else? Easy stuff. Okay. So let's go through. Well, I'll just answer Randy's question real quick. First, what are the opportunities? Obviously, there's a ton of opportunity, but it's a federal program. So the assumptions are a federal program. So there isn't really like governance on a municipal or a local level or anything like that. So pretty much all the guidelines, all the rules, all the everything are federal. So it's anywhere in the U.S. really, all 50. So let's talk. What I'm going to go through is let's start like what is an assumption? These are the things I'll cover. What is an assumption? What loans out there are assumable? Why are assumptions so popular now? That's kind of an easy one. I think the slide's probably a little outdated just because people are hearing about it now because of home affordability. Why is it important to agents and investors? You'll see that assumptions in general aren't necessarily hey, I need to learn how to do an assumption because I'm going to do an assumption, as strange as that may sound. But a lot of agents are using the assumption platform as more of like a lead generation platform or tool. So where they're able to get past that the psychological block that a lot of buyers have, which is rates are too high, I can't buy a house. So you're able to get past that bit with the low rates of assumptions. But what you'll find is if you're dealing with primary residence buyers, you're looking at like 30 to 40% of those buyers that you've attracted through the assumption platform, they'll end up doing just regular financing. So they're going to transact with you, but it's either an assumption or traditional financing. Investors, which you guys deal a lot with, they are obviously very focused on the deal or the financing package. So not many of them are gonna flip over to regular financing. But investors are very low hanging fruit when it comes to the assumption market because realistically, and I'd love to hear if you guys have any other ideas, but I have not seen anything else from a residential real estate investment perspective that's as good as an assumption. There's just nothing out there that's better. It's like it's the thing that investors have found. But what I'll also go through is, what's the catch? And what I mean by that is so many people hear about assumptions and it's like, this is great, too good to be true. You have agents that'll go talk to their buyers and sellers. And again, oh, this is too good to be true type of thing. I will go through because it's not all roses. Assumptions are tough. I mean, it's a tough part of the market, meaning, and like I said, if you don't set the expectations well for clients, it's worse than like it's a crazy transaction in general. But the results are always good. So, and then we talk about kind of like what is like how do we fit in here? How does UME fit in here? How does, Mitch as like the as your guys like LO contact or loan officer contact, how does he fit in? He's the one that's going to be doing all of the we call pre-screens, but it's really just a pre-qualification for assumptions. And then also what he does is he'll do like a dual approval. So he'll be able to qualify, say, for example, you pull a primary residence buyer or any buyer in, he'll be able to say, this is what they're good for in the new financing world and the assumption world. So when you have them out there shopping, they can look in whatever market they want because they'll be pre-qualified in both sides. So, and they'll be very different the way that those pre-quals look. And you'll see that once you have a couple of buyers over to Mitch. So you'll see the differences. But let's start. Okay, so you guys focus a lot on investors. Who can give me give me your best explanation of what like a sub two or a wrap is? Can anybody do that?
Well, a sub two or a wrap is taking over payments on an existing loan, but not with the bank's blessing and not officially. It leaves the original loan holder on the mortgage. So
Exactly.
it's not really ideal for them.
Exactly. And that is not at all
Yeah.
what we deal with. And as you know, Art, we don't deal with that at all. Have
Right.
I done like wraps in the past? Sure. But from an assumption perspective, we don't deal with sub twos, wraps. We deal only with like the real deal above board by law government loan assumption program. And that is the key difference between the two is in the real world or the real assumption world, the seller is no longer liable for that loan. You literally have a buyer that comes in and their name goes onto the loan and the buyer or the seller's name comes off of the loan and it becomes the buyer's loan. It goes onto the buyer's credit, comes off of the seller's credit. It is the buyer's loan. And that is the key difference between sub twos and wraps is that liability and responsibility perspective. It is completely above board. There's no worries of a due on sale clause type of thing. And you have like a complete transfer of title and responsibility. Now, what I'll get into in a little bit is you have a little bit of a nuance, and again, in the investor world, you're going to be dealing with this a lot, is you have VA entitlement. And VA entitlement, for a lack of better terms, is really like a credit line that every veteran has with the VA as to like how they can go out and purchase homes. So you'll have most veterans don't understand too much like how their entitlement actually works. So many of them will think, oh, if I allow an investor to take over my loan, I lose all my VA benefits. Not true. Or they'll say, oh, I can never get another VA loan again, or I can't have a second VA loan. All of that is not true. So we'll go into that in a lot more detail. But that, I think, Nadia, what we were talking a little bit earlier is how you're saying, how do we educate listing agents? That's the big piece specifically in the investor world that you want to get pretty adept at is how to give a good explanation of how entitlement works. And I'll do that in just a little bit here. And
That's
like
perfect.
go ahead.
Oh no, that's perfect. So you're saying with the VA that it doesn't encumber it. You know how they get money down to put down on the house. If they are going to buy another one and they have this assumed, does it affect that at all? Do they still get the?
They can do that's what I'll get into that in a lot of detail
Okay.
in a bit here, but yes, that there's basically kind of a sneak preview. You get a certain credit line depending on the county that you're buying in. If you have like
Mhm.
$400,000 that's tied up in that first loan and you allow a non-veteran to take it over, that means you're going to have in say for example in Maricopa County another $437,000 left over. And so you can buy up to that with zero down. But I'll get into that in a lot more detail because that is truly the only really confusing part of the assumption market. So, so we'll get into that in a lot more. Let's talk about, okay, so which loans are assumable? Does anybody know what loans are assumable?
Well, we have Vanessa on here, and so she does. Works with her husband. He's a veteran, so of
Okay.
course the VA is, and FHA. There's the
VA,
two.
FHA, yep. And technically, because you'll hear this, USDA is also assumable, but the terms for a USDA assumption don't make any sense.
Mhm.
Unless it's a family member to family member, you have to take whatever the current market rate is on the assumption. So it doesn't make any sense to do it, right? So I ignore USDA altogether. FHA is primary residence only. And then VA is any occupancy that you want, second home. Like it's a huge advantage that basically that the VA gave their veterans. They basically said, hey, listen, you guys, when you guys are selling your house, you can offer it to anybody you want. So it's a huge competitive advantage for that veteran because they can offer it to another veteran. And if they do that to another veteran as a primary residence, they can do what's called a substitution of entitlement, where their entitlement doesn't get tied up. So that new veteran buying it, it goes onto their entitlement. But they can also offer it to investors, and that's where it becomes encumbered. But they say you can go ahead and offer it to investors, non-veterans, whomever you like. And so, like I said, I'll probably focus a lot more on the whole VA side of assumptions because that's going to be more applicable to you guys. And really, it's the only confusing part because FHA is super straightforward. Buyer comes on, buyer goes on to the loan, seller comes off of the loan, transaction is completely done, primary residence only. There is no entitlement involved in FHA or anything like that. So it's just super, very, very straightforward. Another question I get all the time is, is there really are you hunting for unicorns out there for assumptions? And the reality is you're not. It's, about 25% of the market are assumable loans, which is FHA and VA. So there is a quite a big market out there for it. And to be technically correct, so there are some conventional loans, and this is also a red flag for you guys. There are some conventional loans that are assumable, and those are really conventional arms. So you're really not going to run into them all that often. Conventional arms are only assumable after the fixed period. So don't get caught up with if you have a seller that's like, oh, I've got an arm, it's assumable, let's sell it. If they're in year 2 of a 7-year arm, it's not assumable for another 5 years. So you want to be very careful about that. You want to be very careful again if you're on the listing side of your seller saying, or of your seller saying, hey, I called into my bank and my bank told me it's assumable. And I can tell you the number one bank right now is Chase Bank, that they just tell everybody that all their loans are assumable. Because technically the conventional loans can be assumable, like if there was a death and then an heir is assuming it, or if it's a divorce situation, that's another way that loans are assumable, but it's only assumable to the spouse, or the spouse or ex-spouse. So it's not assumable to the general market. So Chase will just say, yes, they're assumable we took a little digging for us, but apparently the reason is they don't want to be or they don't want to increase their liability by accidentally telling a veteran that his loan is not assumable when all VA and FHA loans are assumable. Which is another thing. You don't need to call into the bank if it's an FHA or VA loan and say, hey, is this loan assumable? Because it is. So you don't need to worry about that. But let's look at, okay, so this is another, I know that the general market has finally heard a lot about assumptions, but if you look at this graphic, this is the reason why there's such a lack of education of assumptions out there, is basically because the last time people really implemented or used assumptions was back in the 80s when rates spiked here. It was a big deal that, if you went to the bank and you were going to get an FHA or VA loan, it was like 18%, but you could assume someone's loan at 11%. That was a huge win, right? Like you save 7% on your loan. But since then, we have 40 years of rates going down, which means you're never going to assume someone's rate at 8% if you can just go down to the bank and get it at 6%, or your lender, right? Get it at 6. So you wouldn't assume it. So now that rates have kind of spiked a little bit, again, that's where all of a sudden you have a lot of consumers looking for home affordability and alternative ways to buy a house. And so it's becoming much more prevalent in the market now. I can tell you that investors were the first to come to the market because they self-educate and they're always searching for what's that new best thing. And when they found assumptions, I would say probably out of our first 500 assumptions, I think probably about high 300s to maybe 400 of them were investors. We're probably floating around a 50-50 now because finally the agents are educating the primary residence market that it's an option. So there's a lot more primary residence happening. But in general, it was a huge investor market to start. Another reason why a lot of people just haven't heard about assumptions is there's realistically someone like myself who I've been doing lending, just regular lending for like 25 years. We started the assumption processing side about 3 years ago, but then Mitch, a very experienced lender. They're the best profession to really educate agents about assumptions. But the problem is if you educate agents about assumptions, and let's say, for example, Nadia, you have we have a mutual buyer and you're out shopping for a house and I've done a pre-qual for you and they're looking at new financing and then all of a sudden you see an assumption and I'm just a regular lender. So, and then they see an assumption, I can't make any money as a lender. I just lost that client. So you don't have lenders that really want to educate about this because they lose clients to assumptions because there's no money to be made for a lender. So that's one of the main reasons. Another reason that I've seen is definitely you've got agents, just that whole fear and doubt thing. If you guys remember the short sale days, you had a lot of agents that were just afraid of it. It's like it's something new, it's something unknown. I just want to keep doing what I'm doing. But realistically, if you see those agents that really leaned into assumptions into short sales back in the day, they built big teams because you had a lot of these banks that recognized the agents that leaned into it, and they're like, we've got all these like these foreclosures and all this stuff we need to sell, and you seem to get it, so please do it for us. And that's what we saw here. Like, for example, I know that Florida was hit hard, but in Phoenix it was hit really hard too. So it's just one of those things. So like why would an agent really even care to know about assumptions? It's going to be one of the big things that I've heard from a lot of agents. It's a huge competitive advantage because, and I put on here that your clients will ask about it, but it's in the news now. Like it's a hot button, the whole, like even Trump announcing, his administration saying, hey, we're thinking about doing portable mortgages and 50-year mortgages and then assumable mortgages. So it's a buzzword. So they're going to ask you about that. So the more you know about assumptions, like the more educated and the more the expert that you're gonna appear, right? Even if you're not an expert like Art. But so um, but one of the things that you're gonna see in the assumption market, again, using it to your benefit and being able to really attract buyers and sellers is, I mean, you might say, hey, a seller can get under contract faster, and a lot of times for more money. But really what you're going to see is like, how do you quantify that? How much faster can you get under contract? How much more money can you sell your house for, right? And the market's really going to dictate that. But pretty much all of the data that we have basically shows that you do get under contract a little more quickly because you're able to offer like a super competitive financing package along with the house. Now, how much? And I just had this question today on because I did that a Zoom that I told you guys I do on Tuesdays and Thursdays. But I did a Zoom, and one of the questions that one of the agents had was, how much of a premium can I expect? Because I have a 1.9% interest rate and I have like a $400,000 loan. Well, the reality is the market is going to dictate that. It's not going to be a premium like, let's say, for example, you have a home that's $500,000 and you want to, and that would be like the say the market value, what you would list it for. What you don't want to do is you don't want to list it at 540 because you say, oh, I've got a great loan. What normally happens is if you list it at 500,000, and let's say, for example, normally you would get offers at say 480 with 3% in concessions. In the assumption world, you're much more apt to get a full price offer with no concessions. So that's really where you're going to see that difference in the bottom line to the seller. It's not necessarily above what the you would list it at, like, oh, I'm going to list it at 500, but let's list it higher. It's the difference between what the market is offering and what the assumption market would be offering. So that could be so 3% in concessions, 20 grand difference. That's like $35,000 difference in a net to the seller because they were able to command a higher price in the assumption world. Okay, so who's done an assumption? Has anybody done an assumption? Gone through the whole process?
No, I've done the subject to and all that with another brokerage I was working with, but no assumptions yet.
Okay, so no assumptions at this point. So I can tell you that again, it sounds great when you're talking to buyers and you're talking to sellers and all the benefits about assumptions, but there are a lot of things that are not benefits. One, for example, is timeline. You may get a lower payment, you may get a great interest rate, but you don't have a 15-day, 20, 30-day close that you do in the traditional financing side. And one of the things that you definitely do not have is the certainty of that timeline. I promise you that whatever you write on your contracts as far as a closing date, they like the servicer, and when I say servicer, I'll say it over and over and over. That's just the seller's current mortgage company. They don't care what you write on that contract. They close whenever they can close. It's just that simple. Like if you say, oh, they're supposed to be about 60 days, and you write 60 days on that contract, again, means nothing. So that's part of the setting expectations part when you're talking to a buyer or a seller is, hey, we're going to shoot for 60 days, but we might have to extend it another 30. We might have to extend it another 45. It's the seller or the servicer is going to close when they can close. Now we've got a great, we've hired UME and they're like the nation's assumption specialist, and they're going to be kind of like watching over this whole thing and making sure it's moving forward. But there is no specific time frame. You're not going to be able to get your movers set for a specific day or anything like that. You really won't know your closing date probably till about 7 to maybe 10 days before the closing date after going through like a 70-day process. So that is definitely one of the drawbacks of the assumption world. Both you and your buyers slash sellers are going to feel like you're in the dark because the communication is terrible from servicers, terrible. Um, Now we've put together a portal that we can try and update people as much as possible, where they can log into the portal and if anything has happened. But again, this is a very much a hurry up and wait industry where we hurry up, but then a lot of times we might be sitting there, like the file might be sitting at the servicer in underwriting for 3 weeks with zero progress. And it's infuriating to those A-type people like myself that want to see why isn't this more efficient, but it just isn't efficient because the servicers, they don't really want it to be efficient because they lose money on every single deal that they do. The only reason they do them is because they have to by law. So if you have a willing seller and you have a qualified buyer, they have to do the assumption, but they lose money on them all. So they basically take the least valuable players from all of their company and they put them in the assumption department. And like, that's what you have to deal with. Well, what we have to deal with. So we grow all that. This beard right here used to be brown. It used to a while ago, but it's all gray now after assumptions. But so the servicer again, they would like nothing more than if the buyer or seller canceled. So when you have, again, if you haven't set expectations well and the buyer or seller are like, well, I'm just going to cancel this if it's not done in the next 2 weeks, right? Well, that's not gonna do anything for a servicer. Now, a new financing lender, of course, I'm sure it would because they make money and they want to get it done. But you're working on the opposite end of the spectrum. This company loses money by doing it, so they want you to fatigue. Um, Not all of them are malicious, but they just love that you would cancel. So it's a different dynamic. Other things that you're going to run into with servicers, for example, servicers will figure out any reason that they can to deny a file, whether it's right or wrong. And if you ever give a servicer the opportunity to even say the word fraud, immediately like that gets shut down at the servicer level, and there's no way to turn it around, even if that person isn't trying to commit fraud. And I'll give you an example. So we had an agent in one of our classes that she was in the middle of an assumption that just got denied from PennyMac. And what had happened was the buyer was coming from California and he was switching jobs to a job in Arizona. So they went under contract and he put it down as his primary residence because he's going to move into it. All makes sense, right? Well, his job wasn't starting until 90 days after the closing date on the contract. And technically, you have to start within 60 days. You have to occupy it within 60 days. So that gave PennyMac the opportunity to call the mortgage application fraud. because he was putting primary residence, but it was not technically going to be his primary residence for 90 days. So they shut it down. And we, even when they asked us, hey, can you at least try and turn this around? And we have a good relationship with PennyMac, there was just no turning it around. So you're going to have these servicers that will try it, whatever they can do to try and deny it. You're going to have servicers that will, especially in the investor side. Now, they don't really do it to us anymore just because we work with all the major servicers and they know us and we know them. But to the general public, you'll have a lot of them like Mr. Cooper, Carrington Mortgage. They'll still say, sorry, you can't do an investment property with a VA loan. And a lot of times people will just Google that, right? Can I get an investment property with a VA loan? And most of Google is going to say no because they're assuming it's on the origination side, and you can't buy an investment property if you're getting a new VA loan. You can only do it on the assumption side. So they know that like most of the time, like insurance companies deny claims, they do the same type of thing, and they know that you guys will give up, or you just don't know the rules well enough to push through it or overturn their denial. So you've got the no investment properties. You've got, oh, well, you're not allowed to use secondary financing. You are allowed to use secondary financing. And then like a future class or whatever, when we're talking, I'll go through, I have a whole story where Rachel actually went to the head of VA and stood in front of him for 10 minutes while he was on the phone at a servicing convention in Florida, just because we were having problems with that secondary financing. We worked directly with VA and we got that changed on a VA level. So you are able to use secondary financing. For investors, you got to put at least 20% down. For primary residents, it's 5% down. So let's see. So red flag for listing agents. I've got that. I told you about that already. Okay, so let's talk specifically about entitlement. And then
Mike, can you say that real quick? That last part about the 5% and the 20%?
So if you're for secondary financing, and let's use an example of secondary financing, you're buying a house and it's a $500,000 house and there's a $400,000 assumable loan on there, right? Most people, not most, but many people think that you have to have that $100,000 of that gap and you have to have it in cash. It's not necessarily true. You are allowed to use secondary financing. And secondary financing would be just like when you take a HELOC out on your house, right? And you use that for whatever, same concept. You can take a HELOC, it's called a purchase money piggyback HELOC. You can take a HELOC or a home equity line of credit out on the house that you're purchasing. So let's say, for example, you have $500,000 purchase price, $400,000 loan. You've only got $50,000. You don't have 100. You can put the $50,000 down and then get a second mortgage or a HELOC for the other 50 on that house. So you don't have to have the full amount in cash. Now, knowing that you guys are very investor focused, investors need at least 20%. And to be honest with you, of all of the assumptions we've done, we haven't done a single one for an investor with secondary financing because they always have whatever the amount of cash is that's needed to cover that gap. But it is available at this point with at least 20% down. So in the case of the 500 and 400, that wouldn't work for an investor because that's 20% down. But if it was 500 and say 250,000 second mortgage, they could put down 100 and then get that other 150,000 in a second mortgage. So
And that's
And do
just for
you
the secondary financing, right?
I'm
In that
sorry.
case, that's just for the secondary financing. You have to put down 20%, or like you don't have to put down 20% in every case. Well, I guess you wouldn't, not in every case, right?
Not every case. So it's 20% of whatever the sales price is, and then whatever's
Okay.
left over is what you could do in
Okay.
secondary financing. So it's of the
Okay.
sale price.
So the
Um,
investor has to put up to 20% of their own money, and then after
up to,
that, they can borrow if they want to, if they wish
right.
to.
So if it's a $500,000 sales price and a $470,000 loan amount, investors only putting 30,000 down, right?
Okay.
So
Got it.
that's the difference, the gap.
Okay. Got it. Thanks.
So let me go to. I'm going to click off center
and
share.
who is regulating that?
Hey,
Is
Mike.
that the sorry.
Couple questions. Go ahead. So Nadia said, who's regulating?
Yeah, I mean, because you're assuming that mortgage, so the assumption, the actual original loan, they're requiring you to do the 20%.
No. Sorry. So the first loan, the original loan, they don't care what you do. Meaning, like, if that seller were to say, "Oh, I'll do a seller carry for all of it," and you're doing
Yeah.
zero down, that the first doesn't care at all. it's regular conventional secondary financing. They're like, yeah, we'll do a second loan for you, but you got to have at least 20% skin in the game.
Okay, I understand.
Yeah, it's just underwriting guidelines for that. And that's Mitch does all of that because that's what I'm saying. He's on the LO side and we're just, we're a one-stop shop for all things basically lending and assumptions. So when you're doing that secondary financing, that's where Mitch would source that. And there's very few places that can actually source assumption secondary financing, which is different. And Randy,
Nice.
you had a question?
Yeah, I've got an interesting question. It's a numbers question. So what happens when the purchase price and the value of the loan are incredibly tight, right? So what happens if you're coming in and you're assuming a loan that is, 90% of the purchase price? So how do you come up with that 20% cash down? Do you need to immediately pay down that loan by 10% to get the LTV? Like, how does that, how do you do that?
The 20% is only mandated by secondary financing. So if there's less than 20% of equity there, then there is no secondary financing. So there is no need for, it's basically the lesser of. You're going to pay the lesser of whatever the gap is or that secondary financing. But you do bring up a good point, which is becoming more and more common, at least especially here in the Arizona and Colorado markets. And I'm not sure about Florida yet, but when you have it, when it's especially tight, let's say it's a $500,000 loan amount and a $498,000 loan, right?
Yeah.
It's like the buyer's like, that's fantastic. That's a $2,000 down payment. And it is. It's a $2,000 down payment. But what happens with your commissions, the listing agent's commissions? How does all of that get paid? And then that becomes your problem as the real estate agent of like, how do we get paid? Because the seller's not getting any money, right? Because they're only getting $1,000 basically from those closing costs. They're going to have their own closing costs. They have their agent and then your agent. So that is one thing that you're going to run into.
Okay.
To dovetail on that, you might end up coming across $500,000 purchase price and $550,000 loan amount. So they're selling it as a short sale, right? In the assumption world, there are no short sales. And what I mean by that is you can assume basically a short sale, you can assume that loan, but you have to assume the full amount of that loan. So even if the purchase price is $500,000, you have to assume a $550,000 loan. You can't assume a shorted amount. So sometimes it might be worth it. And we've done a couple of those where you had it was probably like a $380,000 sales price and a $387,000 loan amount. So they did it because it was only about a $7,000 difference and the financing was fantastic. So sometimes it's worthwhile to do that. Sometimes it's not. But let's hop over because I want to get a little bit more into the, let me get here. Bring up UME. I want to get into the entitlement a little bit more. So I'm going to share a different screen. Okay, so you guys can see my screen here. All right, let's go to entitlement. So this is actually 832, 750 now. Okay, so this is how entitlement works. Now remember, without me turning this into like a VA loan class, basically you have VA home loan benefits, and VA home loan benefits for veterans are broken up into two pieces. The first piece is eligibility. Now, eligibility is a yes or no. It's a binary yes or no. Can I get a VA loan? Yes or no. If I'm a veteran, was I honorably discharged? Yes or no. Can I get a VA loan? If I'm active duty, do I have enough time in the service already? Do I have enough credits? Can I get a VA loan? Yes or no. That's eligibility. Now, the second part of that is entitlement. A lot of people use those as synonyms, but they're not synonyms. Eligibility is if you can get it. Entitlement is basically that credit line that you have with VA, for lack of better terms. Now, entitlement is also broken up into two pieces. You have basic entitlement and bonus entitlement. And this is going to be important for you guys to know, especially on the investor side. But basic entitlement for a veteran, it's changed over the years. Some people are like, oh, I thought it was 750,000. Oh, I remember it was $1 million. where they can get up to $1 million or up to $750,000 with zero down. Now, basic entitlement now for probably the past 10 years or so is unlimited. So what that means is you can go out and buy a $10 million home if you wanted to with zero down as a veteran, as long as you obviously qualify for it from a credit and income perspective. If the more common example, though, is you guys run into, say, a veteran that's selling their house and they're selling it for 500 and their original loan amount was 350,000 and they're looking to sell it potentially to a non-veteran or an investor. So if they do that, they will have an open VA loan after the transaction is closed. And they can go out and purchase another another home with using VA financing, but they go into what's called bonus entitlement. Now, bonus entitlement, it's a calculation. It's basically whatever county that they're buying in, you subtract whatever their original loan amount was on their original loan, not the current loan amount, but the original loan amount. And then so you subtract the county loan limit minus that, and that's what your bonus entitlement is. So I'll show you this. So let's use that $350,000 example. So you had an $832,750 is the conforming loan limit. Is that in your guys' county too, Nadia? Do you know just the Fannie Freddie limit?
I believe that's what I saw. It's right in that. It should be right around there.
Okay,
Yeah.
that's the lowest across the U.S. Unless you guys are high cost in Tampa, this is going to be the lowest it could be. It could potentially be higher. So if you have a veteran with an original loan amount of 350,000, I just hit next here. Their bonus entitlement is $482,750. Now, does anybody know what does that mean? What does that mean if I have a veteran that has that?
If they can borrow that additional amount with zero down.
That's exactly right. They can go out and get another VA loan up to $482,750 with zero down payment. Can they go above that?
Yes, with 25% down on the additional amount.
That is also correct. Sounds like you might have gone through one of our classes, Art.
Yeah, or you might have told me, buddy.
So let's say, for example, they want to go out and buy a $450,000 house, right? But maybe they're looking at a $600,000 house or even a $700,000 house. They can still do that with a VA loan, but what you'll see here is the $450,000 house that's under the 482, so it's zero down. The $600,000 house, VA just says, okay, well, you have to come in with a down payment. Now, the down payment is calculated by whatever the purchase price is minus the bonus entitlement and 25% of that difference, which comes to $29,312.50. I would suggest just clicking add comparison and it'll calculate it for you. And this is something where understanding this part, and when you're talking to a listing agent, if you're on the buyer side and you're asking, well, what is your veteran planning on doing? Oh, they're going to go buy another house. Okay, whereabouts are they buying, etc. So you can get a basic price range. You put some of that information in here, and this is all through your guys' website, and you can create a PDF out of it. And this is what a lot of agents do when they're submitting offers now. So it gives this PDF is going to be branded to you, right? So this one's me because it's my login, all my login stuff, but it'll be branded to you guys. And then it gives a basic explanation of what VA entitlement is, and then it'll show those examples. So you can give that to the listing agent so they can also express it to the seller, especially if you include it with your offer so the seller has to see it, that says you still have options. It's not like you're giving up all of your entitlement. And the part I love about this is here you'll see, feel free to reach out. So anybody can get in touch with us, right? And we can answer all the questions because we do this all day, every day. But it also gives the VA Regional Loan Center, just an 800 number, they can call VA directly so they can verify it with VA, and VA will verify everything on here. So that's just a little bit more of a strategy thing when you're putting in offers. Because one of the things that, and this is again for you guys, for setting expectations with your buyers, if they're investors or non-veterans, you're probably going to be successful in 1 out of every 5, 6, or 7 offers that you send in, asking a veteran to give up their entitlement. The success rate, what we've seen, like I said, probably is about 1 in every 6 or so. So you need to set your buyer's expectations that you guys are going to write a lot of offers in order to get this financing. Because if you don't, they're gonna hear from friends that it's a buyer's market, and oh my gosh, Vanessa cannot get me under contract. She must be a terrible agent. I've sent in 4 offers and I haven't had a single one say yes yet. So you got to set their expectations of what the assumption market really is. Um, and this is, if you happen to see on like the website that someone is advertising for veterans only, this is just another kind of like tidbit, ignore it. Send in the offer anyway. Because what happens is any veteran that lists their house, like it's only been on market for a few days, especially, they're always like, I want the highest price. I want the fastest sale. I want only a veteran primary because I need to substitute my entitlement. And so it'll be a knee-jerk reaction, no. But after 30 days, when they realize they're not getting the fastest sale, the highest price, or whatever, and they might have to give up some of their entitlement in order to get this thing sold, or they see that in the non-veteran world, they're getting an extra $30,000 net, a lot of them start changing their mind. And when they're coming back to you, if you're dealing with investors usually don't really care that, oh, well, they didn't accept my offer 30 days ago and they weren't primary residence buyers and already in another house. A lot of times they'll come back because they have your offer, it's still there, and they'll say, okay, hey, Art, is your investor still open to the house? And many times your answer will be yes, or you have another investor that would want to buy it. So always submit the offer. Conversely, if you're on the listing side, I would never put veterans only. Just because you get offers, even if your veteran is very, very like adamant of like, I will not accept an offer from a veteran. You don't want to say that we will accept offers from non-veterans, but just don't put veterans only, because what you're doing is you're limiting the data for your seller. So the offers that you have come in that are from non-veterans, obviously you don't have to accept, but it gives your seller data. This is what the market of non-veterans is offering. So if and when 30, 45 days down the road, you have to revisit with them, hey, we're going to do a price enhancement. But if we look over here, this is what it looks like the market that our non-veterans would be offering for this. So I just wouldn't put non-veterans in there. Any questions on that so far? All right, so
Nope.
let's look at a couple other tools on here. And all of this, you have all of these tools within your guys' website. I'll talk about, let's do amortization real quick. Okay. So this is one that people don't think about, but when you have engineer-minded buyers, and especially investors that are really looking to like calculate the value of the financing, this is one of the things that they will put into their cash on cash returns. Your normal average buyer going out and buying a house, they don't really look at this, the amortization side of things in the assumption world. But again, your savvy investment purchasers or your like software engineer type of guys, they will. So here's an example of a house that that we actually sold, or we didn't sell. We were part of the assumption transaction, but it was a younger financial analyst that bought the house, and he paid $50,000 over list for the house. It was on sale. It was listed at 900 and it sold for 950. And that was above what the like any appraisal would ever come in, which is also great in the assumption world, is there is no appraisal unless there's secondary financing. So you don't have to worry about these, value issues. So he spent $50,000 above it. And we asked him, like, why did you spend, like, that's a lot of money to bid up. And he said, I've got young kids. This is the school district I want to be in. This is the high school I'm hoping they'll go to. So I'm here for the long term. The original loan on that was $765,000 and the rate was 2.875, and it was taken out in August of 2021, right? Now, when he did the purchase, the current loan balance was 725. So we're doing an apples to apples comparison. And I think that it was 6.99 was the interest rate at the time for a regular conventional loan. So let's calculate that. Now, the first thing that a buyer's like what's the first thing a buyer always looks for? What's the first thing they look at? Payment. Payment. They always look at payment, but let's look beyond that. Even though the payment's great. So here on the assumable loan, the payment is $31.73. Apples to apples comparison on a conventional loan, just at market rate, $4,800. So they're saving $1,700 a month, right? So right out the gate, $1,700 a month. It's basically 2 years that he's already recouped that overpayment in principal and interest, but it goes beyond that. So this is especially powerful for if you guys are talking to, you're a buyer that's like, here's a house that is not assumable, but I don't like the finishes as much. The doorknobs are so much better. The countertops are super nice. The flooring's better. Take a look at the total interest left to pay on the assumable loan here, $377,000. Because remember, you are taking over that loan from the day that you close on it. So this is a 30-year payment, but you're only paying it, in this case, for 25 years, not 30 years. And the total interest left to pay on the regular conventional loan is over $1 million. So you're saving basically $700,000. So it's like buy your own flooring and save the 700 grand in interest over the course of time. So this is something that you will have. Again, your savvier buyers will look into this. Now, another thing here, let's look at the amortization. So if you look at that $4,800 payment, look how much is going towards principal and look how much is going towards interest. So you basically got, call it $595 going towards principal. Now, how much of the assumable loan is going towards principal? This is a question.
1341.
Okay, what if I told you that's not right? That's not right. Why is it not right?
Or are you referring to the assumable or the standard?
Assumable. You're looking at this right here, right?
I am, yeah.
What month is that?
Oh, okay. So you'd be down somewhere around 35
You
months.
got to go down to the 5th year. You have to look at the amortization table at the beginning of the 5th year or whatever point you step into the loan.
Exactly. You got to go down to whatever month that is that you step into the loan and where are we payment?
Month 63, 64, whatever it is.
Yeah.
5 years in.
64. So this is the amount now going towards the principal. So that's something that you can obviously show the investor or whomever you're showing also. So from an amortization perspective. Now let's go so blended rate. Blended rate you're not going to deal with on the investor side as much because most of the time they do have that down payment, but this will happen especially with a your primary residence buyers. And I'll go back to that $500,000 purchase price example and $400,000 loan. So let's say you have a $400,000 loan and it's at 2.875%, right? And then let's say your buyer has 50,000 down or 10% down of 500,000. So there's a 10% down. And they say, okay, but what happens? What's the interest rate on that second mortgage? Or is it just regular rate, like 6%-ish? No, it's not because a lot of people will think you can get a second, basically another first mortgage. First mortgage means first lien position, means if it goes into foreclosure, they're the first to collect, right? So you can't have two first mortgages there. So you have secondary financing, which is like the HELOC that we talked about, home equity line of credit, or a fixed second. I can tell you that fixed seconds, we've done very, very few of those because everybody always ends up choosing the HELOC because the rate's lower and as you pay it down, your payment goes down. So let's talk about the HELOC example here. So let's say, for example, they have decent credit scores and they're putting 10% down and they say, okay, what's the interest rate on that second? Oh, it's like 8.25%. And they're like, 8.25% mortgage? I mean, what's the first thing that they say?
That's
out.
a lot. Yeah.
That's a lot. I'm not paying 8.25% on a mortgage. I am out. Right. And so the first thing you got to do is you got to say, okay, hold on. Let's look at this. So let's look at what the blended rate looks like. And blended rate is just the old high school weighted average between two amounts, right? So if you get a $50,000 second at say 8.25%, your blended rate or the overall interest that you're paying on the total debt is 3.472.
This is a great tool that you have here. This is amazing. So you can show this to your clients then.
Yes. And you can do, I mean, you can create a PDF out of it again too. It's super
Awesome.
basic, right? But
Mhm.
it's such an easy concept, but if people don't think of it, they're like, I can't do 8.25%, right?
Mhm.
Or a lot of times what you'll have some people do is they'll do an average between the two rates, not a weighted average, but a regular average. And they'll be like, oh, that's 10, it's 11. So it's like 5.5%. That's not so great, right? But it's actually 3.472. And as you pay down that second, which is the idea when you're talking to them, is any extra money you have, pay that down. Let's say you get it down to 25,000. Now your blended rate's 3.191. Remember, it's two separate loans. You're not mixing the loans together, but you have two separate loans, but you're just doing a weighted average on those. So this is another one of the key tools that you guys will use. Now, if we go to the property search, and this is getting into the website side, the like what your consumers are going to see and what you're going to see. I'm just going to go to Tampa here. And I can show you this. You can see it all. You have the same thing here on your guys' website. It's identical to ours, meaning like all the same functionality and everything. I'm just showing you on mine because I'm already logged into mine. So I'm here in Tampa, right? And let's try and find, wow. I just saw that one that was like $2,000 down. Okay, here's a great example. Here's a 0 down. Let's take a look at this one. This is 0 down. The estimated rate, see where it says assumed rate? Now, unless this is certified, so this is another thing that you guys will do with us. When you do get a listing, first thing you want to do is send us a mortgage statement. So when you send a mortgage statement, and again, I'll have all this in like, we'll put this in writing kind of and stuff for you guys, but you'll send it to certifications@umeprojects.com. When you're on the listing side, we take that, we certify it on the website, which means we know all the numbers are exact. So the interest rate will be exact because all of the interest rates, there's no public data that has the interest rates. So this is interest rate is an estimate based on the day and year that this was taken out. So we search public records, we see the day and the year and whatever the prevailing rate for VA was. So this could be 2.25% if they bought it down a lot. It could be higher, say 4% if they used a down payment assistance program. So, but this is in general, it's good to about 0.25%. So we look at this and we're like, okay, 3.11%. Original loan amount was 575,000. So this is a great example. Estimated loan balance. Randy, this kind of goes to what you were looking at. $525,000 is the estimated loan balance. So I would look at this, been on the market for 2 months. So if you're an investor, would you do if basically 0 down for a 3% interest rate?
It could be that it's a little bit higher, but I mean, you got that low interest rate.
Right. So you look at the payment. So if the payment is 26.25 per month, let's see here, payment calculator. Oh, look at this. Okay, so it's actually they even put it in the listing. Pricement, it's a 2.75% VA assumable mortgage. So I'm just going to happen to put 275 in here. So now it's more accurate. It's 2.75.
On our side, are we allowed to change that too? Edit it?
When I edit it, it edits it for all of the
Everybody? Oh,
yeah,
okay.
for everybody. So it's changed on your site now too. And it does it like immediately. So that's now changed on there, and I'm looking at 2514 payment. That would mean that your guys, what this is telling me is your property tax is super low. Would your property tax be super low there?
St. Pete is a lower. In comparable to other states, it is not high.
Gotcha. Okay, so another part of the functionality that you guys have on your site, and if you're logging into our site or wherever you log in, because you'll have a login, this loan comparison here, this isn't on for the general public, but you can click on the loan comparison and it'll immediately print out like what it would look like if you did a regular loan versus the assumption. And let's take a look at this one.
But Mike, that is PITI. It's not just PNI.
Let's take a look. It should be, yes. Yeah, PITI. The principal and interest is 2347. PITI, monthly taxes and insurance. Yeah, that just for some reason that seems low to me. I think
Those are
something's
low.
off
Well, a
there.
lot of times they may have a super low tax rate because of whatever their status is. If they're disabled, if they're a disabled
Yeah, very
veteran,
true. That
right?
would
So then that might not apply to the new owner, the new purchaser.
Mm-hmm.
but if you look here, just if you compare just principal and interest, right? This will default to a 10% down conventional loan is what the usually there's three options. One is the assumable with whatever the down payment is. The second is with secondary financing. In this case, obviously there's no secondary financing, and this will be a 10% down conventional. Um, but you can always change those numbers. Here you're putting 51,500 down, you're putting zero down. And if you look at just at least the P&I, because that's going to be accurate, you're saving $600 a month and putting 50,000 less down. So these are the types of like tools that you can show your buyers to say, here, this is where you see the value. Or if I were the listing agent, this is what I would put into my documents, in the listing, something to show that the value of that, like putting zero down and you're getting a $600 a month lower payment.
Mm-hmm.
That one looks like I just
So
happened to.
you'd load that into you'd upload that into your docs on your listing so that everybody can peruse those.
I would, yeah, on pretty
Yeah.
much any of your assumables. I'm going to go to Tampa again. And you have all the filters up here, like by loan type. Again, if you're looking for investors, you would just do VA and then apply that. If you have a specific like interest rate that you're searching for, everybody always wants the least, right? But let's just say we're going to do nothing over 3.5% or somewhere around there. So we're going to apply that. And you'll see what's still available out there. Like this one right here, you guys have some great opportunities here. So this one
Yeah.
looks $50,000 down. So that's effectively 15% down at 2,375. So this is something, I mean, I would be looking at from an investor perspective. Like
Mhm.
what would this property rent for?
Well, right now we have a corporate rental right next to it, and it's a 3 bedroom, and it rents for around 4,500 a month.
$4,500 for something like this in Riverview?
Mm-hmm. Well, that's a 4 bedroom. Ours is a 3.
That's just crazy to me.
Yeah, because you got 2,000 there, which even if that is just principal, and then yeah, you'd be making almost double.
Yeah, man, how is that even possible? That's incredible. So this is like, you guys really do seem to have a lot of opportunity there. You're going to
Mm.
attract a lot of interest with the assumption, especially on, I mean, if they're willing to give up their entitlement here. And if you look at their initial loan amount was 336, 155, that means they have plenty of entitlement left for whatever they're going to be buying moving forward. So this is the type of thing where, again, if you're looking at this, you can look at if it's a primary residence and you're going to only put 5% down, you have a slider here that you can do. And you'll see like here, the secondary rate is going to be with only 5% down, is going to be closer to 11%. So so for rule of thumb, like if you're talking to buyers, etc., if someone has at least 10% of the sales price to put down, the world's their oyster out there in the assumption world. If they only have 5% to put down, they're going to have more limited opportunities because if there's a large gap there, that blended rate's not going to be so super attractive if you're only putting 5% down. But yeah, this is one where you put together a loan comparison, take a look at this, and I mean, you're saving basically $800 a month with just about 17,000 more. Yeah, got a lot of good opportunities out there. But I think I gave you kind of a quick overview of everything. I know it was a lot of info. But what questions do you guys have? Otherwise, I think that's a majority of just like the basics that I went through, whether it be on the
Can you,
website or assumptions or anything.
Can you talk a little bit about maybe how we set expectations for our clients about whether or not they can qualify? Because I know, like for myself, I can qualify for, in talks with you, I can qualify for one property,
Right.
right? That's not that exciting for most investors,
Mm.
but that's because I'm self-employed and I write everything I can off, you know.
Right. So the first thing you want to do, like I was saying, is where you guys will get in touch with Mitch, and then Mitch will do a pre-qualification, and then he'll have one on the new financing side, right, and then one on the assumption side. For example, the guidelines are probably about 70% the same, but for investors, they're very different in a couple of key areas. For example, if you're buying with Fannie Freddie, just a regular, conventional, normal mortgage moving forward, and you find an investment property and you're putting 25% down, you can use whatever the potential rents are. Let's say, for example, if we're buying this property, whatever that property rents for, I can use those rents to offset whatever my mortgage payment's going to be on there. So from a debt to income ratio perspective, so I can qualify
Long-term rents, right?
on,
Long-term
on
as opposed to
long-term
mid-term.
rentals. Yeah, on long-term rentals with just Fannie Mae, Freddie Mac. So basically, they look at the appraisal and they say the appraiser says it's going to rent for this much, and you can use like 75% of that value, and you can use that to help qualify. In the assumption world, can't use any of that income. Let's say, for example, you've just purchased 3 or 4 properties in the last 2 years, and you don't have 2 years worth of taxes. In the regular financing world, not the assumption world, you can use lease agreements or you can use 1 year of tax returns, again, to offset those mortgage payments. So you don't have to count them against your debt to income ratio. In the assumption world, you have to count all of those mortgages without any of the income. So it's a very different like qualification for investors, which is why it's very important for you guys not to waste your time with that nightmare investor. And that nightmare investor is usually the guy that makes 500 to a million a year. He's got 830 credit scores. He just bought some properties and he's like, my buddy owns a mortgage company. He said I'm good to buy another 7 properties or whatever that number is. Um, because he's gotten pre-qualified on the new financing side. And he said, let's just get me under contract. It's just a formality for me to get qualified. A lot of times, and it's happened more than you would think, we've had to go back to that person and say, I'm sorry, you don't qualify because you have just recently acquired properties and we can't use any of that income. It's different. But when they do get pre-qualified on the assumption side, we'll calculate what's called an MDS or monthly debt service. And that's basically how much money or how much of a payment that they can afford. And so, like we have an investor right now, and his number was 80,000. So he can take on $80,000 a month in debt. His plan, he wanted to buy 40 properties at an average of about $2,000 a property in payment. So every time he buys a property from that 80,000, he just subtracts whatever the payment was. And he's starting to move up into $4,000 and $5,000 payments now. So let's say he bought 5 properties at an average of $5,000 in payments. He was at 80,000, subtract 25,000 means he can still get another $45,000 in payments moving forward. So we basically get that for to investors. So if someone's like $7,000, for example, which is maybe a little more common, they can decide, oh, I can just get one really great big house that I'm going to do a short-term rental on, or I can split that up into 2 or 3 houses with my down payments. So on the pre-qualification side, that's what Mitch will come up with is that number for your guys' investors. And so the other part of that is when they are pre-qualified, and again, you want to make sure that they do get pre-qualified in the assumption realm. When you're putting offers in on properties, I would say 9 times out of 10, Mitch or myself or somebody will end up speaking with that listing agent because the listing agent may have heard of assumptions, maybe they've done a couple, maybe haven't done anything, and they will always have tons of questions and they'll ask about the pre-qualification. How do I know this person is qualified? So we can help facilitate that, which helps your guys' deals go through because it's just the education piece. Because I guarantee you that listing agent and the seller, if they don't know much about assumptions, the first thing that they do is they self-diagnose with Dr. Google, and they'll look up things like what's the success rate for assumptions, and they'll literally come up with like 20 to 60% is the success rate, right? Because when people try it on their own, they don't understand how it all works. And with the servicers trying to deny these, like you would say, 6 to 8 out of 10 fail, right? They just don't go through. we do all of that work up front so we can give that security to the seller. Like our closing percentage is like 99% plus at this point because we do all of that hard work up front to know if it's going to go through. And when we do get a declined file, because we get them all the time too, we know how to overturn those. So that's where it becomes important that they're pre-qualified. So when the listing agent calls, we're not like, I know Nadia is the buyer's agent, but I've never heard of this guy, right? So we're able to give that comfort to the seller.
Nice.
Thanks,
So
that was good.
that was a long explanation for a short question, Art.
No, the question was, what kind of things should we be setting? I'm all about setting expectations, right? And sometimes that little bit of making it a little harder even works in your favor when you're closing a deal, right? Because it's almost like a take it away close, right? So I'm all about setting the expectation. So that's perfect. There's a multitude of things there to talk to my clients about.
Yeah. You'll just, with the buyers, you definitely want to set expectations that it's a harder, you don't want to make it seem like it's too easy because it's not. And it's so funny because if you go, and in fact, I don't think I have it up right now, but we just got a 1-star review on Google. All the other ones we have are 5 stars, but we got a 1-star review, and to be honest, I haven't responded yet because I love it. I think it's the best review that we've had because it came from a seller, and the seller would call like every day, right? Every day, because she needed to know when her closing date was, because her kids were going to go to a specific school district and she didn't know where to register them. And she had all of them, and she was very nervous, right? And if you look at the review, it's funny. She goes, I don't know where all these 5-star reviews are coming from, right? She goes, I don't know why they're getting them because you can't call in on any day but Thursday. And if you do, you get in trouble and like all this other kind of stuff. So my response to this is going to be very much like everything she says in here is true, right? Everything she says is true. The communication is not good from servicers. It's just not, it's not a great transaction for somebody that needs to know where everything is at all times. She's like, you can't call in on any day but Thursday. Very true. One of the things that we've done is we are very strict on, we literally have to take off and not work on Thursdays, meaning like not proactively work, because we have to update everybody to satisfy those emotions, because we have, every party of the transaction is looking towards us. It's not like in the regular financing world where it's just like the buyer or the buyer's agent and it's super easy and that's who you communicate with. We are communicating with everybody. So we have to be sure that we limit that communication to Thursdays, because otherwise, and we ran into this probably about a year ago, we hit a wall. If we are responding to the hundreds of emails and calls we get every day, just people that are nervous and wondering what's happening, it's like we get no work done. So we've stopped that. And we're like, okay, everything will happen on Thursdays. And a lot of those updates on Thursdays, meaning coming from a servicer, it'll be exactly like it was last week and the week before. We're still sitting in underwriting waiting for them to clear conditions. And people get frustrated with that. But then again, that's setting expectations. That's what's going to happen. At the very end of transactions, this is another expectations thing. So, and I'll give you an example. At the very end of transactions, what happens is the servicer doesn't always do exactly what they said they were going to do. A good example of that is with escrows. So your property taxes and your homeowner's insurance. Everything's been set up to where it gets prorated like you normally would in a regular financing transaction, right? But then at the very end, the servicer, let's just call it Freedom Mortgage, says, oh no, we're going to refund them all to the buyer. We're going to give them all to the buyer, or we're going to leave them all in there, and we're not going to refund anything to the seller. So at that point, we have a choice. And when I say we have a choice, that's me, you, the buyer, the seller, whomever. We have to figure out, okay, what do we want to do with this? We can either fight it and tell Freedom that they're supposed to do it how it was set up and that we have a legal contract and they really need to change that. And that can take 3 weeks for them to do that simple change. Or we do a quick addendum to the purchase contract that raises the sales price, the amount of the escrows that are being lost. So everything washes out exactly how it should monetarily for everybody. And that seems like a last minute change that a lot of people get upset about because they're like, something went wrong. So somebody's not doing a good job, but that's not the case. That is servicers, and we have to do a lot of last minute things like that in order to make sure that we get it done, as quickly as possible. So again, that's a setting expectations perspective of like, hey, these are rocky, but they'll get done. Have I pounded that into your heads enough that we need to set expectations with?
I'm looking for more of those low trouble clients anyway, so it works out perfectly with my new goals for the year.
Right.
So why is it that they take so long? Because obviously they don't want to let the loan go, but is it like you said, they're just the low end employees that are
It's I hate saying that too because we work with them every day, right? That they're low end employees, but many of them are low end, but it's also that they understaff and then they understaff and overwork. They really do. Like we had like I remember I think it was Mr. Cooper at the time, their whole department quit on one day because all of them were like it literally came down to, and we just had the inside scoop with this, but one of the girls was closing on a house. And as soon as one of the workers at Mr. Cooper, as soon as she closed on that house, she's like, I'm out. And she was like the leader of their whole processing side. And they don't have these vast departments of assumption processing. It's usually like a handful of people. And once she closed on her house and she didn't have to be employed at Mr. Cooper anymore, she quit and everybody quit. So now Mr. Cooper had to like retrain a whole new crop of people. So there's a lot of turnover in that position, whether it's underwriters or it's, processors. So
and what is it that's taking them so long? I mean, basically they're just underwriting, making sure the buyer is the new buyer is qualified.
no, it's more like imagine if you had 37 buyers that wanted you to take them to see houses in 2 days. You just can't get to them all, right? So it's more of that. They're just so backlogged and they're not going to hire and make things more efficient and invest into better systems.
That makes sense.
That's really the main reason. And they get stuck and nobody in that department can really make a decision. Like there's nobody that nobody's empowered to make a decision. Ultimately, like if you're for us, meaning like you, me, our vision is a little bit well beyond like what we're doing. Ultimately, I would love to, in the end, to put together a national processing center and basically contract with all the servicers so that they're just like, I don't want to deal with this anymore. So I think a national processing center that had kind of like a standard process I mean, it would make this whole market so much more efficient. But until then, it's just not going to happen. The servicers aren't going to invest money in it.
Okay.
Mike,
That makes
can you show that rater or whatever that shows which banks are closing in what amount of average time?
Yeah,
Do
so
you have a
let's
way to
look at,
show that?
yeah, it's right here. So you guys also have access to this too, recent turn times. So let's look at some of the good and bad ones. So Bell Bank, they're not really, but so like Carrington, for example. Carrington, they're a larger servicer. I would say mid to large. But their estimated days of a transaction are 84 days. Now, about if you're speaking in generalities with a client, usually you say about 90% of servicers fit within the 60 to 90 day range, right? They all fall right in there. 5% of them are faster, 5% of them are slower. But in general, like here's a good example. I just had a client today that had heard about us through some other realtor, and it was a real anyway. Long story short, they had started an assumption that they were going to do on their own, and it happened to be with Chaffa. Chaffa is a Colorado Housing Finance Authority. Look at their estimated days,
Ooh,
14 days.
wow.
These guys with M&T Bank and PHH are the worst in the industry by far. They just don't want to do them, and they will do everything they can not to do it. And Chaffa, we've had to force them to do a couple now. 2 out of 3 that we've done with them in particular, we've had to force them to do the assumption because they just said they're not going to do it, but they're not allowed to say that. So this is an example of a servicer that's terrible. They were going to try it on their own, thinking it was going to be a 45-day close. I'm like, you guys, it's just not. I don't think you're going to be able to get it through on your own, and it's going to be well past that. They're going to make it very difficult for you. Cross country, this is a little bit different. This is a little misleading. For example, they're estimated as 95 days, but this one was 210 days as an average. Our most recent one was 210 days with cross country because they don't actually do their own servicing, but they don't tell you that. So we went through the whole process with them on our first one, and they're like, "Oh yeah, sorry, we weren't supposed to do that. You have to go to Mr. Cooper. They're our actual servicer. So some of these days can be misleading. Freedom Mortgage, for example, I would say we do the most with Freedom Mortgage right now because they're very government heavy. And so they basically, the expected is 84 days. Our average with them is 73 days. Our most recent was what, 45 days, and that was on the 14th. What's the date today? So 6 days ago was our most recent closing with them. And then you can look at like all the other recent closings. So you've got 45, 80, 138, 52, 73, 73, 62, 57. So as you can see, it's kind of all over the place. But so there's no way to say like in traditional financing it's a 30-day close. But yes, this is where you can take a look to see, to get at least a gauge on what it would be like. See M&T Bank here, 107 days, 95 average. Our most recent 88. They don't want to do. They're terrible.
Mhm.
PHH. Well, let's find PHH. Average is 129 days. Our most recent was 135, and the estimated is 123. So this is another one that I know that is not good. So that's where if you have a list or a potential listing, you can set their expectations as to what the time frame will most likely be.
And so we'll know which loan, which one they're with before we start.
So what you would, yeah, so you would get a mortgage statement from the seller. So if
Okay.
you're on the buyer side, you're like, I need to see a mortgage statement because you want to verify what the terms are, right?
Mhm.
Or if you're just talking to the listing agent, what's the interest rate? What's the balance? Who's the servicer? That's really the three key pieces that you need to know to kind of put together an offer.
Would
Okay.
you ever tell the listing? Would you ever share this information with the listing agent? It seems like a good credibility tool, but I wonder if it would turn them off a little bit.
What do you mean?
You know, with this, well, for my buyers, I think this is a good credibility tool, right? Just showing this is the how many transactions they're doing. We UME deals with all these banks, right?
Right.
But I wonder if showing this to the listing agent, would I show this to the listing agent?
I mean, you could if you wanted to. I don't think you even need to go that far. You can say from our experience, this is, it becomes a little bit of a strategy if you're trying to figure out how long it takes to close. Strategy most of the time, right? I can tell you again when we'll go through like trainings and best practices. As of right now, the best practice that we see is you write it for a 60-day close, kind of regardless, unless it's one of the terrible ones. You write it with a 60-day close with an automatic 30-day extension. And that fits again, about 90% of the people are going to fit in there. So, but if you're talking to somebody and they're like, yeah, you guys are PHH, it's going to be a miserable experience. It's going to take 129 days. I mean, you might shut down the seller before you even get started. You know what I mean? But
Yeah, maybe you just set the expectation again and say, hey, we're gonna do the best we can do,
yeah,
or we're gonna do everything we can do. But
but
it's
you
up to the
definitely
bank.
want to let, I would say, the seller and the listing agent know, hey, we've contracted with a company that this is what they do. Because the only thing the seller really wants to know is, am I going to close on this thing? And how long is it going to take? Right? When do I get my money?
Right, right.
So,
And then maybe suggest that, take up backup offers so that they feel comfortable to keep it that long.
yeah, I don't, it's funny because I've had agents ask me that. And as long as the buyer and seller are good with the time frame, I don't, there's never really a reason to, you could do backup offers, of course, um, but we close them. We close them all. They don't fall out per se. And if you could also have if you had a buyer that's especially primary residence, it's like, this is the house that I want, and I want this house no matter what. And for some reason, the assumption just is like brutal, or we say up front, I don't know if this is going to go through as an assumption, because we've done that before. We're like, listen, this one is like, it's really sketchy. I don't know if this is going to go through or not. There's a lot of interpretation. They could very easily deny it, and we would lose the appeal with VA. And we've had people have backup offers to their own offer with traditional financing, and we've gotten them all through, fortunately. But there are some that we have said this they really would be a coin flip, because we understand what servicers are looking for when it comes to the gray area versus, new financing lenders are easy in gray area.
Do you have an example of what really holds them back? What are some of the conflicts?
Um, I don't know if I would say conflicts as much, but let's say, for example, you have uh for example, it's not really a conflict, but like self-employed income, right? We're experts at it because we do it all day, every day. We've been doing it for 25 years. And we are experts at it in the assumption world, which is slightly different than the new financing world. So we understand it. But these underwriters at these banks, they get confused very easily. Like I said, they're not very high level and when you have like 32 different tax returns or corporations that feed into like a specific type of pass-through entity or something, those underwriters just don't get it, so they just say no. Oh, the income's not there. So we have to
Mm.
go through that income with them and say this is how it all works, right? So those are the things that take time. Is if you have, again, especially in the investor world, that's way more common than it is in a primary residence world. Um, you've got that. You've got. We just had one that was just. It was such. It was. It was horrible to try and push through with the servicer, but we had a veteran that was he went through like flight training school to fly, and he was an actual pilot flying for like a year and a half. So they said he didn't have 2 years of job history, right? Which is absolutely not true, because you can use education specific to whatever they're going to be doing as job history, period, end of story. But they kept pushing back on saying that that's not a job. Your education is not a job, right? And it just dumbfounds anybody that knows anything about lending, that how can they actually do that? But they stuck to their guns on it. We had to actually go all the way through VA. We had to appeal it to VA. Like, I have no idea why these guys are so stuck on stupid. And of course it went through because it's an obvious one, but there's a small amount of gray area there. So those are like examples of like, and there's thousands of things like that they can do, right? There's nothing that's always specific, but it's just when they don't understand is when they get confused, they just say no.
Gotcha. So mainly it's the buyer documents, stuff like that, just trying to get them pushed through.
Yeah, they push through their structure. You've got other things. For example, the seller's behind on payments, and they won't even open up the assumption until a certain amount of those are paid off, right? And they didn't tell you that at first, so they have it sitting there for a while. And we learn that as we go, which specific servicers won't allow an assumption to be even opened until they're caught up on payments, versus one that'll allow you to do it at close versus one that'll allow you to do it anywhere throughout the transaction. But in general, for example, you have to have all of your back payments caught up before you close. So which isn't necessarily the case in new financing. So
Mm.
there's
Okay.
there's a myriad of things that slow an assumption down.
Okay. Is there anything that do you have like a checklist that maybe we can make sure our buyers are already into to help make it move forward?
Um, a checklist as far as like common things that are realistically, there's only a few, and I can put together a checklist for that. But the few are definitely the make sure that the payments, because you always want to get a copy of the mortgage statement, because if you don't, you won't be able to see if they're behind in payments, right? So being behind in payments is one. Obviously, if they're in foreclosure, it's another one you just want to check off the list. As we run into that. And then just knowing who the servicer is. Those are really the big ones.
Main things. Okay.
Because once the buyer goes through, a pre-qualification with us, then we're not worried about the buyer at that point. It just becomes a seller loan thing.
Okay.
What do you think, Vanessa?
Oh, can you hear?
What do you
It's a
think?
lot of information.
Right? A lot of talking. A lot of talking to give out a lot of information. But yeah, no, you guys will definitely have questions like as you go. But
Awesome. I'm excited, man. I'm excited. You said talk to Travis about getting an individualized website.
yeah, so we'll have to get that set up.
Okay.
And then Nadia, I'll have you get in touch with Travis too, or we'll kind of like put together like how do you want to handle all of that? Because then we start more on the lead gen side of things too, and then Patrick will become involved in that to kind of help you guys. Like how do you how do you lead gen through assumptions and, get buyers, get sellers, and some ideas, and whether it's social media advertising, whatever it is.
Okay. Yeah, that's great. I know he's seen some advertisements, so we're trying to figure out how to get this out there to the most people.
Right.
So that would be great. And yeah, this is great. So you have classes you have Zoom calls every so often that maybe we could jump in on, or
Yes, I do. It would be noon to 1 your guys' time.
okay.
So that is, if you look on even here on, I'll just go to the website on UME here. Just right here, so you join our virtual Q&A,
Okay.
and just it's the register now, and you'll see they're all Tuesdays and Thursdays at specific times.
And do you go over anything specific different, or is it always pretty much similar?
It's always like a Q&A so far, but I think what we're going to do with the whole pivot that we've done, I just haven't had a chance to get to it yet, is I'm going to start creating more of like we're going to cover a topic like each one. Like I'll say, okay, this date's going to be this topic, then we'll record it. I just haven't got there. It'll probably be a couple weeks before I have that all laid out. But I think I'll do about a half hour on a specific topic and leaving about a half hour for a Q&A.
Nice. Okay. Very neat. Yeah, this is a really great program. I'm really excited that Art connected us with you, and I mean this could definitely grow here in Tampa. There's not too much in the area for this, so we don't see a lot of talk about assumptions here in Tampa that I know of. And me and Vanessa, we used to work with a large company that did off market, and this it wasn't really part of that process back then. So
Yeah, well, whatever we can do
Yeah,
to
I'm
help.
excited about it too. I think it's gonna be great.
yeah,
So I'll get Mitch to put together kind of a summary email too, and then kind of like what are the next steps for you guys, right? Obviously we have Nadia, and then Art will get with you on the whole website portion of it. And then so we can kind of do some training around that. But then for like agents, it's like, okay, I have a buyer, what's my first step? Okay, I have a seller, what's my first step?
yeah.
And then from there, after that, it'll be how do I get buyers and sellers? So
And then
Okay.
if we have website questions or technical questions, we hit up Travis, right? So we're
So
not
no,
bothering you with that
technical
kind of stuff.
questions you can shoot over to me. Like if they're just like, how do I do
Well,
something on the website?
we're
Yes.
having a trouble. Like if you do the search on our deal, if you
Mhm.
don't put in Tampa, Florida, it doesn't pull up anything. So if you put in Dunedin, Clearwater, St. Petersburg, it doesn't pull up anything. It just has individual addresses. So I just assume that's for the tech support guy.
Oh, that's a common thing. So you're talking about if you go, let's say, right, let's go back to
You
your
go to
main
Tampa
site
assumptions and then you go
right here,
Tam
like
if you
that.
put in Clearwater, yeah, it doesn't it pulls.
So take a look.
Oh
So you
well, it
just
looks
go
like
to
it, so
you
maybe
just
it
go to
pulls
the
it.
city because it'll have the city first and then all of the
I
ones
couldn't get it to pull though. I can't get it to click through.
like that.
Yeah, maybe it's a setting or something on my computer.
I can help
Maybe
with some
something's
technical questions.
well. That seems pretty easy. I think. Thank you for that.
Right.
So, all right, I'll keep trying. I'll keep working on
Yeah.
it. Maybe it's me. I don't know how I can mess that up, but anyway.
That was a comment. We fixed that a little while ago.
Oh, okay, okay,
That was one.
Yeah,
okay.
and it seems to be fixed. The IXL seems to still be working. It does look pretty good on my side, I am seeing. One thing you didn't touch on was UME. What is the name for?
Oh, UME?
Yeah.
All right. So let me see if I can find the original. Here, we'll do it right here. Can you see our logo right
Yep.
here?
Uh-huh.
So we started the company like about, a little over 3 years ago. And we are like, okay, what do we name it? Because we had to figure out a name, right? And so I was like, what would be awesome is I don't even think Ume was born yet, but that's our daughter. We have a 23-year-old, 21-year-old, and now a 3-year-old. So Ume is her name, which is my wife's grandmother's name, Ume. So we were trying to figure out something creative, and I was using, it's UMEI. And I was just like trying to do all these creative things, and we're both just sitting here trying to figure something out. And the I was killing me at the end of UME, so I couldn't do anything creative. And then Rachel's like, "What do you think of this?" So she draws a donkey, right? She draws the donkey with basically ume, but just left out the I because this is the traditional spelling of ume. It's a Japanese and Chinese name, um, but puts a donkey here. So I looked at it and I was like, oh, I love it. I get it. So does anybody know why is that clever? Why is it creative?
My gosh, I just got it. How long
Oh,
has it
wait,
been?
you already know? You've already heard this.
No, I hadn't heard it. That's awesome. I
Oh,
hadn't
you
heard
haven't
that.
heard it?
No, I love it.
Oh, do
It's
you guys
funny.
know what
I didn't know that.
Oh,
creative?
yep.
Yeah.
What is it, Nadia?
The assume, like assuming. It's
Yep.
you're an ass for assuming.
That's exactly right. It spells out assume. It's an
Yep.
ask UME.
Yep. I like it.
That's great. That's great. I love it.
Yeah, that's how we came up with that.
Oh, okay, that's funny.
I know, right?
That's
So
good stuff. That's cool. I'm glad I asked.
very cool. I thought you knew what it was. That's why. I love it because every once in a while I'll still get a call from like an agent just out of the blue, and they're like, they'll just be like, "Oh my God, I just got it." 'Cause-
Yeah, I'm feeling a little slow over here, but I still love it.
right?
Yeah. No, that's good. They'll remember that for sure.
Oh
Yeah,
yeah.
that's good. That's good.
Yeah, good stuff.
Cool.
Okay. Well, yeah, I love the tools. These are really, really good. One thing is I am having trouble with logging in, so I'll get in touch with the tech as well.
Yeah.
Just the login portion. But oh man, I'm seeing properties that I want to buy. So, but you're saying there is a cap on these though because they don't take the income.
There's a
portion.
cap, a debt to income ratio. There is no cap on from like a Fannie Freddie 10 finance property rule. That doesn't exist. It's just how much money can you prove and can you handle in your debt to income ratio. So
Okay.
that's one of the things where if you have an investor, I'll just kind of, and again, we'll put this all in an email. I'll have Mitch do it. But if you have like an investor or if you have a buyer that's just like, I just want to get started, like, where do I apply? I just like, there's a house, I just want to do it. You just you go to Assume Now. It's just assumenow.com. And that goes directly to the application.
Okay.
So it's like, I want to get started right away. That's it. Like our website's great and all, and you can apply through the website. But if they're just like, I just want to do it now, it's Assume Now. And then they create the application, fill it all out, put in their paperwork, and then they
Oh,
go.
nice. Okay. Very cool. Well, thank you so much for doing this today. I really appreciate it. And I'm glad that at least some of our agents were able to be here for this portion of it. But we did tape it, so we'll be able to share it with them as well. But I think this is going to be a big pickup here in Tampa, would be the assumption, especially with the interest rates the way they are right now.
Especially with some of these deals I started looking at here.
Yes.
3% with this is like another 15% down. The sweet spot that we're seeing is 15% or less down with like a sub 3.5 rate investor. Again, it's this one's FHA, so you wouldn't be able to do an investor, but um, it just looks to me like you have a lot of opportunity there. A lot.
All those houses, it's like they're in Tonopah, Mike.
Oh, these are like Tonopah houses? Got it. Okay.
Not quite, but they're kind of a trek.
That explains it.
The
But
Riverview area. I would live there. Just it's a trek from it's a long commute.
yeah.
Yeah. Oh man, but there's a lot of homes on here that I've gone through and they're very good quality, especially with all the flooded homes too. So I think that gives an advantage.
Oh wow. Okay.
Wow.
So would you even bother talking to these agents before you submit an offer, or would you just
Okay.
submit an offer and then call them? Because I've been reaching out to some agents and
So from a strategy perspective, and again, we'll
yeah,
have strategy like times where we'll go through stuff as far as best practices, but I would highly not recommend calling agents ahead of time to ask if their veteran is open to allowing their entitlement to become encumbered. Because all those big words, they have no idea what you're saying, right? And knee-jerk reaction from most agents that don't understand VA assumptions well is either no, because they don't want to look stupid asking their seller, what in the world does that actually mean, right? Or if they ask their seller, it's like, hey, do you want to sell your house and allow your VA entitlement to be encumbered or tied up? And again, knee jerk is no. But if they have an offer in front of them, then they're usually open to at least hearing about it and being educated. So my suggestion, what we've seen as successful, is always send the offer and then follow up. Send the offer with a good little email,
All right, that's good.
follow up with them like, we are happy. And a lot of offers I'll be CC'd on, just like, hey, this is Mike at UME. If you have any questions about assumptions, etc. Or the agents that are very like well versed, they just put feel free to call me. But yeah, with the offer, they are more open to being educated.
And
Is
then
it
you're
possible?
just
Oh, sorry.
I'm sorry, no, go please.
Well, is it possible that you could send over an example email of somebody that really did a bang up job on submitting it to the seller?
Yeah, I can just kind of like it's super simple. Like most of them are super basic, but yeah, I can shoot that over to you.
So until we actually engage in a conversation and get a statement, though, we're not 100% positive of their interest rate.
Absolutely, that's correct. Those are
Okay.
estimates.
Nice.
But you're pretty accurate on VA versus FHA.
Yes, yeah, for sure.
Yeah. Okay. Okay. And then because that's similar to like PropWire, right? It gives an estimate of what the interest rates are, so you're not really able to get exact numbers.
Right, exactly.
Okay. Is that where you're pulling things from, the public record, maybe something like that?
Basically what we do, how the website works is it takes all the MLS data. And so effectively what it does is just identifies if it's live or not on the MLS. And then we pull in all of the public data to cross-reference with what's live. And anything that has a VA or an FHA loan is populated on there.
Nice. Okay.
All right. Super cool, man.
All right, you guys. Well, it was great having this little class with you. That was fun. And then we'll definitely be in touch. And then I'll have Mitch get that stuff out to you guys, kind of like with next steps. And then I'll also have, when you do have questions, like with Travis in particular, so we got to figure out your strategy with what you're going to do with the website.
Okay. Thanks, Mike.
Anybody else have any questions or anything? Kenna? Okay.
None here. Thank you, though.
All righty. Thank you so much, Mike.
Very cool. Thank you.
All right. See you guys.
Thanks, Mike.
Yeah,
Thanks.
talk to you soon.
All right. Talk to you soon. All right. Bye.